my business is in the financial services space. We specifically help business owners and entrepreneurs with their finances, whether it be cash flow or protecting assets. That's where I spend most of my time. Where Henry and I got to know each other is not only on that side of the space. Coincidentally, I've got another vertical of my business where we are in the real estate business. Separate from my financial business, we personally have assets that we own that we've purchased that we have our investment philosophy and how we follow. A lot of the work that we do in the financial planning space is designed to educate individuals and business owners how to control their money. And why that's important is because we're programmed how to think about money, oftentimes by the financial institutions and the government. And the programming of how we think are designed for us to buy financial products. And those financial products are designed to hold our money for long periods of time. So the government earns more tax revenue. So the financial institutions earn more revenue, period. And oftentimes, as you peel back the onion, you realize that some of the things that we're told to do with our money is not necessarily or may not necessarily be the best thing for us, but maybe the best thing for them. So I've spent the last 25 years of my career studying how wealthy people make financial decisions. And the single biggest differentiator that I've recognized in how wealthy people make financial decisions is they control their money. They invest into themselves. They invest into things that they can determine the outcome, and they really hyper focus on how to protect themselves from downside risk. And that downside risk isn't only in the volatility of the investments they make, but it's specifically related to how they mitigate taxes or how they protect their assets from volatility or inflation or interest rate risk, like Henry mentioned, or death or disability, lawsuits, the wealth eroding components in life, the things that we don't have control over. So that's sort of the basis of our practice. And Henry asked me to speak with you all today a little bit about the specifics of how we could integrate some different financial instruments to sort of accelerate our process and buy real estate in a more accelerated manner. So Henry, I'll kind of turn it back to you. If you have any questions or things that you want me to focus on today, I'm happy to do so.
I mean, like, look, not only is he my financial advisor personally, but this guy, is buying some of the greatest investment deals ever. And we actually joke around of who buys better deals a lot. And, I'd love for you to kind of share about, the velocity of money and how you kind of see money differently than most. I think it'll be really, really supportive for these guys.
Sure. So I think a good way to start is by how we think about money, right? And what I mean by that is if you almost think about the difference of money where almost think of a dollar sort of as a physics experiment where like an object at rest stays at rest. So we're told to park money into different vessels, whether it be CDs or 401ks or IRAs, and those assets then sit in those buckets for 20 or 30 years. But physics tells you that an object in motion continues in motion. So if you start to look at your money in a manner that we can create multiple uses of a dollar, we can start to think like the financial institutions think, and we can start to create more wealth by virtue of the process of how that money actually accumulates. When you think about your money, I almost want you to think about how banks make money. So banks make money, and I'm going to share my screen because I think it'll be helpful. So banks make money by earning what we call multiple uses of a dollar. Banks don't take investment risk. They take what's called financial risk, meaning are you going to pay them back? So if you have $100,000 in your checking or savings account, the bank's paying you interest for that money. They're lending it back out to you on a mortgage on a property that you might own. They're then, as you make those mortgage payments, lending it back out to you on your home, on your vehicle, if you're leasing or financing a car. You make your monthly payments times thousands of people, and they're lending it back out on credit cards and so on and so forth. And as a result, through the concept of fractional reserve lending, which folks is the main money theory in capitalism, it's keeping money in motion. The banks are earning anywhere from 50+% on the money that you have on deposit on an annual basis. And they're not taking investment risk, meaning does it go up or down? They're just taking financial risk, which is underwritten, meaning do they think you're going to pay it back? So we started to think, well, what if there was a way that we can clone that same strategy into our own lives? What if there was a way where we can get multiple uses of a dollar? And many of you are in the real estate business. Henry, I would say maybe almost all of this group is in the real estate business.
Yep.
Okay, great. Real estate is an asset where you also begin to get multiple uses of a dollar. How does that happen? When you buy a piece of real estate, if you wanted to earn a rate of return, you don't necessarily just buy a very aggressive piece of real estate to earn that rate of return. If you buy a piece of real estate, that piece of real estate will give you multiple uses or multiple ways of earning a dollar. So, for example, we would determine buying a good deal in a multitude of different reasons, depending on what our goals are and what we're looking to accomplish. But over a long period of time, over a 20, 30-year window, asset appreciation in real estate goes up what? Is it around 5% a year, right? Over time, long periods of time?
Sure. 3 to 5%, 3 to 6%. Sure.
3 to 5%. Okay. So somewhere between 3 to 5% in asset appreciation over a long period of time. But as we all know, that's not the only asset that you earn when you're buying a piece of real estate. So many of us are buying it for cash flow. If you're buying it for cash flow, that rental income, which is the gross income minus all of the operating expenses. I know this is a little bit more of a sophisticated crowd, so I'll kind of not dumb it down. But that rental income is another rate of return. That rate of return is in addition to the appreciation. So the appreciation is silent. That's going to happen over a period of time. We've got income coming in. Now that leverage vis-a-vis a mortgage is giving us a double rate of return because we're not buying a $500,000 asset or a $5 million asset or a $50 million asset with $5, $50, or $100 million. We're buying it with a percentage of the asset value, which levering it, having that mortgage gives us a higher internal rate of return, more than a 5% return on our investment. Plus, the mortgage interest that we get to pay is deductible off of the rental income. So if you think about it from a personal perspective, the way they tell average people to think, buy a home, borrow as much as you can, but you can only deduct $750,000 worth of interest on your personal taxes. If you're in the real estate business, the mortgage interest deduction is unlimited against an unlimited amount of rental income. Lastly, we're picking up depreciation on that asset. So specifically since 2018 with the recent tax updates, depreciation is a very big driver of why people buy real estate. It's taking property and giving it different schedules as far as a life expectancy and allowing you to deduct a portion of that depending on the IRS schedule and the segregation of those assets, either in an accelerated manner or over a period of time. For the purpose of this presentation, we keep it simple. Let's say that's another 5%. So although we might think that real estate might only go up 3 to 5% a year, a real estate investor knows that his internal rate of return could be much greater if he's factoring in all the ancillary benefits that he receives. Does that make sense?
Yeah, we talk about this all the time. Love it.
Any questions on any of this from anybody? We can certainly make this interactive if the audience would like.
Anybody else have any specific questions?
No, good stuff so far. No questions.
We start to think, well, if we put $1 into an asset and that asset is in real estate or any place else, regardless of the return that we're receiving, it's really only giving us one rate of return, even though it might earn multiple rates of return. So what does that even mean? The way we typically work in the United States economy is we accumulate money and then we take that resource and allocate it towards something. Sometimes it's consumption-based where we're spending it, buying cars, consumption-based homes, vacations, then it's gone, unless it's an asset that has some economic value. Or we take that money. What if there was a way that we can take that money and do something with it, but while we're doing something with it, have it still continuing to grow and staying on our balance sheet as if it never left? Now, when you first hear of that, you kind of say, well, how's that even possible? So think about this. We've started to use financial instruments that give us the ability to have money accumulate and never come off of a yield curve, meaning that money from the day we put it in is going to continue to accumulate and grow over time. And then rather than accumulating and then using it to buy an asset and then accumulate again and using it to buy an asset, what if we can just have money consistently grow and off of that growth buy other assets off of it that maybe are income producing or not and continue to build assets outside of that asset? Well, what we've done is we've started to utilize permanent life insurance policies, specifically whole life insurance policies, as a mechanism for clients to be able to accumulate capital as a resource to save, oftentimes as a way to have some sort of forced savings. And then as that money accumulates, that insurance policy could start to earn multiple uses of $1. So think about it. We can save in a manner where we earn multiple uses of $1 and then use that asset to buy another asset that gets multiple uses of $1. So we're actually getting velocity of money on top of velocity of money. So I'll give you an example. When we park money into any asset, real estate, stocks, wherever you choose to invest your money, you're getting an internal rate of return. Those are the inner parts or features. They're situated within what you're purchasing, and they're surfaced based on what those limits are. But when we buy a life insurance policy, we pick up more than an internal rate of return. We're picking up an eternal rate of return, which in many factors is the most important component. It lasts forever. It never goes away. There's a death benefit component of it that's much greater than what we're allocating towards the bucket. And then in addition to those two buckets, there's an external return, which allows us to create wealth outside of the bucket that we're intentionally trying to create wealth with. So every dollar we put in, we're not getting one spin on that dollar, we're getting three spins on that dollar. And how does that work? We've got these three rates of return that could be used from an insurance policy. So what we start to do is this, and this is, Henry, some of the discussions that we've had. The internal rate of return is essentially comprised of a couple of different things. When you park money into these buckets with an insurance company, you start to develop what's called the cash value. The cash value inside of an insurance policy and a whole life insurance policy is guaranteed as it accumulates. It has a guaranteed rate that these policies pay. It also has a dividend that's not guaranteed, but a lot of the large companies have paid these dividends every single year for over a century. What winds up happening is we accumulate money, and we can have a very measurable goal of, by allocating a certain amount of money to this on a monthly, quarterly, or annual basis, how much money will start to accumulate inside of this bucket in a period of time, 5 years, 10 years, 20 years, etc. We then can start to say, okay, if we have this bucket long term, we get growth on it long term, but what else could we do off of this bucket? So in addition to the internal rate of return, which is the equivalent of put money in a savings account, in addition to the internal rate of return, we have the external rate of return. And the external rate of return is important, especially for you real estate investors that are going out there and taking debt or doing partnerships. The reality of it is there's going to be a point in time when we're no longer here. And upon that date, a life insurance policy pays an income tax-free benefit to the beneficiaries on this policy, which could be great for levelizing partnership agreements. It could be great for replacing an asset to a family. It could be great for satisfying debt or obligations that you have as a result of your business expense. And that death benefit is going to be far greater than what you're allocating towards the policy. Depending on your state, the cash inside of the policy could have lawsuit or creditor protection, which as an entrepreneur or somebody who might be personally guaranteeing loans is very important. Depending on your age and health, there could be disability benefits that allows the money to continue to accumulate in a savings plan, irrespective if you're able to work because of a disability. There's long-term care benefits, and a lot of our clients utilize the cash inside of these policies as an income stream in the future. They can annuitize the policy, take dividends out of the policy, and use it as a supplemental income stream, almost like another passive place of receiving income in retirement. But what a lot of real estate, and more importantly, entrepreneurs in general, not only pigeonholing it to real estate investors, what a lot of people like is the fact that because we've got guaranteed cash inside of these policies, we have guaranteed access to the cash inside of the policy. So to be clear, these policies can grow, they may earn dividends, and as those dollars grow, we can access as much as 95% of the cash that's in those policies at any time. Better yet, the way you access the cash is vis-a-vis a loan. I've got a question. Hold on.
So my question is the eternal benefits, like the disability and long-term care. Is that something like, all right, I have a policy, now I get injured, I can't work, I can start receiving some of that death benefit?
So it's a good question, and there's two answers to it. So the disability benefit specifically is a disability waiver of premium rider. It's not disability income insurance. So disability income insurance is you pay a premium, you become disabled, and after an elimination period, meaning how long you have to wait, think of it like a deductible, the insurance company will start to pay you a paycheck to replace your paycheck that you can no longer earn. What the policy rider does on these policies is, let's say you're putting $50,000 a year or $10,000 a year into this policy as a savings plan. If you become long-term disabled, which typically is defined as more than 180 days, and there's specifications of what that disability means, the insurance company would then continue to make those deposits on your behalf or vis-a-vis waive the premiums because you could no longer make them.
Interesting. All right. Is that typically baked into all kind of policies, or is that something that you have, like a rider you put in yours?
Yeah, it's like building a car from scratch, a lot of these policies. These are all riders that you can add. There's different features that the policies have. You could buy a car with the rims black, or you can buy them with alloy. It's up to how you pick it when it's being manufactured.
Interesting. I have one more question. Can you transfer policies? Say I have an old policy with an old insurance company. Maybe it doesn't have all these riders, but it's it's an IBC policy. You know what I'm saying? Can I transfer those and do something more like this?
That's something that's possible. You would have to qualify whenever you're most likely transferring from one insurance carrier to a next and creating a new policy. There'd be there would be an underwriting process to that, and that's something certainly that you could explore.
Thank you.
So getting back to the eternal benefits, we've spoke about the internal, we spoke about the eternal, and talking about the external, which is really where the power for people who are entrepreneurial come in. But quite frankly, it's really where the power for any individual comes in. And the reason for that is this: far too often we park money into buckets that we can't use for long periods of time. And if an emergency comes up, if an investment opportunity comes up, if we need to use that money to help our children or pay for education, we don't have access to those dollars. So 95% of what is available inside of these policies is accessible. And here's the really cool thing. We can borrow the money directly from the insurance carrier, and that process takes 48 to 72 hours. And many of the carriers have fixed interest rates. So one of the carriers we do a lot of our business with has a fixed interest rate of around 5.6%. So you can borrow money at 5.6%, which, by the way, guys, you're in the real estate business. Where can you borrow money right now at 5.6%?
Nowhere.
Doesn't exist. And in addition to paying 5.6%, the policy will still grow as if there wasn't any money taken out of it, because it's not. Your $500,000 in this example, if you took a loan for 450, your 500 still earns the dividend. Your 450 is what you pay interest on.
Sick.
Now we say you can also borrow at variable rates. So back in 2020, and Henry and I had these discussions, I had lines of credit with third-party lenders. We've made arrangements with a slew of third-party regional banks where they'll give you cash value lines of credit at variable rates. So during COVID, I was borrowing against my plans at 2.75% and using the money elsewhere. And there's no restriction. So it's not like we need to check your credit. As long as the money's inside of the policy, that's the only restriction.
It's like personal lines of credit.
That's correct. And then what you use the money for, whether it's buying a car or buying a piece of real estate or paying for college for your children or starting a business, that's up to you. You don't have to use the money inside the policy, but I think it's important to know that whenever you have an asset, we're always proponents of having three components of an asset. We call those LLC. We want your assets to have leverage, liquidity, and control. I want you to be able to lever an asset. I want you to be able to get to the asset. And I want you to be in control of that asset, not somebody else. This checks all those boxes and then allows us to integrate it and coordinate it with other assets that we're never going to advise you to buy. That's not what we do. We just teach you how to save and how to protect. And then whatever you think is best, we just teach you how to use it. So I think it's a very powerful asset for an entrepreneur. I think it's a very powerful asset for an individual for a lot of different reasons. And I think it's a very powerful asset for people who understand how real estate works.